Factoring is a type of finance where the business sells its receivables for cash. This cash is for meeting current needs, for growth and development, for a lot of purposes that are essential to the business growth and development. Many years ago, I worked in government contracting for the military. We had 5 Army bases, and we had 8 contracts on the 5 Army bases. Now, the military is supposed to pay you in 30 days. There were times that they went 45 or 60 days for one reason or another. And you still have to make payroll, you still have to buy supplies, you still have expenses, even though you haven't been compensated and the service has been provided in a satisfactory situation. If we would have had this tool then, that would have really helped my life in particular. What factoring does, it helps raise working capital. It gives the business the freedom to grow. It is no loss of equity in the business. It's no new debt. It covers weak credit, and the owner can focus on operations instead of collections. I mean, the factoring source generally acts as your collections accounts receivable department. The requirements for this tool is a completed service. The maturity has to be less than 90 days, and the account has to be current and not past due. And what that means is the client completes the service to the customer, issues an invoice to the customer and the funding source. The funding source verifies the invoice and issues between 75 and 90% of the total. Now, let me put this in context. Say you're providing staffing service for company Z. Once the service is complete, you issue an invoice to company Z and to the funding source. The funding source contacts company Z and says, yeah, has the service been provided? They say yes. They immediately send between 75 and 90% to the client. Say the invoice is $100,000. They would send them between $75,000 and $90,000 that day. Truckers, when you drop your load, you'll get paid within 24 hours. You don't have to wait for all of the rigmarole that goes into the transaction being done. So once company Z, the services provide, then they take 30 days, 45 days to pay the invoice to the funding source. When they pay the funding source, say that the source's fee is 3% or 5%. They'll take their 5% out, and then the remainder from that 75 to 90% goes to the client. Now, what determines what the fee is the credit of company Z. If company Z has a good credit, the client does not have to have a high credit. But if company Z pays their bills on time and they do, then the funding source is going to give the client a better rate. Okay? So this, the target audience for this product is startups with high growth. Any startup, if you're growing rapidly, you don't have enough cash flow to keep feeding and generating more sales. Staffing companies, distributors, IT companies, manufacturing, food service, printing, janitorial, trucking, security companies, consulting, wholesale, maintenance, just about any company that provides goods and services to someone else, and then waits for them to, after they invoice them, to pay them, would be a good market for factoring. And the fee for a highly qualified customer, the fee would be so low, it's more than enough value in that to use that service. I have probably 5 to 10 factoring operations that are anxious for your business. Now, our motto is, If we can't get it for you, you can't get it. Thank you.